A lot of Canadians assume that RRSPs are no-brainers when it comes to saving money. But after working with clients, I have seen some costly misunderstandings that lead to regrets, unexpected taxes, and poor financial decision. So, in this video, let's break down the 4 biggest RRSP mistakes I have seen and what you can do to avoid them. Let's start with number 1. RRSP money is not as flexible as people think. Many Canadians regret contributing into an RRSP when they realize how difficult it is to access that money. Unlike a regular TFSA account where your withdrawals are 100% tax-free and your room comes back, RRSP withdrawals are fully taxable and the room is gone permanently. A lot of people assume they can use their RRSP like a regular savings account, but in reality, every withdrawals gets added into your income of that year. For an example, let's assume someone earns $65,000 and they have $20,000 into an RRSP. They withdraw that $20,000 for an emergency, and just because of that withdrawal, now their income jumps to $85,000. Which could push them into higher tax bracket. And on top of that, they can't put that money back into it. Here's a simple way to think about it. Your TFSA, it's like an open wallet where you can move money in and out freely without worrying about any taxes. Whereas your RRSP, it's like a locked vault where once you take out the money, there is a cost. Another thing that people don't expect with the RRSP is withholding tax. When you withdraw from your RRSP, a portion is automatically taken by the bank right away. For an example, let's assume you withdraw $10,000. You might actually receive $8,000 in your hand. And that difference is what we call withholding tax. But here's the catch. That withholding tax, it's not always the final tax. If your actual tax rate is higher, you could still owe way more when you file your taxes at the year end. And this is where a lot of people get caught off guard. So, to summarize this, before contributing into your RRSP, ask yourself this question: will I need this money before the retirement? And if the answer is yes, or even maybe, then an TFSA might be a better option for you. Number 2 is being disappointed with your tax refund. A lot of people think that RRSP automatically gives you a bigger refund. But that's not the reality, and that's not always the case. The size of your refund actually depends on your income. If you're a higher income earner, you benefit more from RRSP deduction. But if your income is lower, the tax savings are much smaller. And this is where expectation doesn't match reality. And another bigger mistakes that people do with the refund is spending the refund. Instead of reinvesting it or using it to pay any high interest debt, many people treat it like a bonus money and they spend it, and that completely defeats the purpose of an RRSP. A smarter approach with your refunds would be either reinvesting your refunds, paying down a high interest debt, or even moving the refunds to your TFSA for tax-free growth. Regret number 3 is contributing to your RRSP without a clear investment plan. And this is a big one. People either do nothing, or they take too much risk, or else they play too safe, and all 3 can hurt your long-term results. RRSP allows you to invest in stocks, ETFs, mutual funds, GICs, segregated funds, but for many people, too many options lead to confusion. So they leave their money sitting in cash, earning almost nothing, and that's where they're losing their money. On the other side, some people go all in on risky investments without understanding market volatility. When the market drops, they panic and they sell at a loss. And then there are those who play it too safe, keeping everything in low interest options such as GICs, which barely keeps up with the inflation, which means that money that has been saved in the GICs doesn't grow enough for the retirement. Your goal is to balance your portfolio. Have a strategy that matches your risk tolerance, time horizon, and financial goals. Don't just contribute for the tax break. Make sure your money is actually working for you and not against you. With that said, we finally come to our number 4th problem: withdrawing in retirement. This is where a lot of people realize they didn't plan properly. Every dollar that you take out of your RRSP is taxable. So, if you already have an income coming from CPP or pension and you add extra RRSP withdrawals on top of it, you could end up in much higher tax bracket. Apart from that, at the age of 71, your RRSP turns into RRIF and you are required to start withdrawing money every year, whether you need it or not, which means more taxable income and potentially higher taxes. And if your income gets too high, you could start losing government benefits like OAS, and this is what we call clawback, and it could cost you thousands of dollars. So a key takeaway is RRSP withdrawals needs to be planned carefully. Taking smaller amount over the time can often be more tax efficient than taking larger lump sum payments. And remember, at the end of the day, RRSP are powerful, but only if you use them correctly. If not, they can create more problems than benefits. The key understanding is when to contribute, how to invest, and how to withdraw from your RRSP. With that said, if you have made it this far, you already understand RRSPs better than most Canadians. But knowing this and actually applying it are two very different things. If you want help setting up your RRSPs, TFSAs, or your overall tax strategy so you are not making these mistakes, I have added a link in the description box below where you can book a free strategy call with me so that we will go through your situations and map out exactly what you should be doing next to avoid the taxes. Until then, see you in the next video.